Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is the weekend question and answer period where I try to answer a couple of questions that I've picked out from some of my readers. Now, I can't answer everybody's question, but that means send them on in, and if I don't answer them on the video, I certainly will respond back via email. So your question will get answered one way or another. So let's get started. This letter comes in from Andy, and Andy writes, I have been following your blog for a few months now and want to ask the following question. The recent evolution of PMI indicates that the stock went from a buy territory of 280, is about where we bought it, into a sell area of $4, which is about where we sold it. And now it is back down to pre-established buy signal. And basically he wants to know, can you buy it back here? And the answer is no. Okay? You have to understand, let me explain to you this way. When we're buying these stocks, we're not buying the price. It's not the price is good relating to the cash flow or the price is right because the PE ratio is this or any other fundamental relationship whatsoever. Okay, we're basically buying a picture. We're buying a ascending triangle. We're buying this look. Okay, and within that look we're trying to get the best possible price we can get within that framework of that picture. Okay, then once the stock starts to move up and goes on one of these explosive moves, which hopefully, and it happens a lot out of these formations, the play is over. And if you miss selling it and you hang on too long, it's going to come right back down again. So now it's back down to the original price at 280. Okay, but the picture isn't there again. Remember, we're not buying a price; we're buying the look, the picture. So in order for that stock to be okay again, PMI, it has to put in another bullish formation. It has to put in a reverse head and shoulders. It has to put in some sort of ascending triangle again. It has to give us another look, another reason for it to buy it. This gives me an opportunity to explain my strategy here with theories. When we're buying these patterns, okay, I believe these patterns are building up energy. And the longer the pattern goes on, the more energy that's in it. Okay, and once that energy is released on the upside in the form of a surge, okay, that's when you'll find me selling. Anytime a stock goes on a little bit of a rampage, whether it be a one-day rampage or a three-day rampage, it depends on the emotional release of these buyers. These buyers are basically reacting on emotions. It could be triggered by a corporate announcement, such as a Taser announcing that some executive was coming over from Microsoft. That creates this emotional burst of buying, and that's what I'm selling into. I'm selling into these people who are emotionally buying these stocks and creating the opportunity of releasing all that energy that was built up, and I'm getting out. And once that play is over, it's over. Just because the stock pulls back down to the same price again, I'm not interested. It could take months before that pattern rebuilds itself. And typically, each stock usually has somewhere between 2 or 3 of these kinds of moves a year. Okay? So remember, we're building we're buying a picture. We're not really buying the price. Price is what makes us profitable, but it's the picture. It's not the price. And a lot of people think that just because it's back, if they miss it, just because it comes back down, it's their opportunity to get back in. Could keep right on going. Could make a lower low. So it's the picture. Now, here's my theory, okay? These patterns that I look for are, as I said earlier, have this, what I consider built up energy waiting to get released, okay? And a lot of times that release comes from a corporate announcement, corporate news, earnings, raising estimates, some sort of news creates the emotional buying that I use to get out. Now, my theory is, but I can't prove this because I don't actually know all the buyers who are buying down in that, let's say, ascending triangle. But I believe that all those buyers down there are very informed buyers. They're probably close to the company, and they may even have some sort of knowledge that something positive may be said over the next couple of weeks, because it happens too many times. And so that's my theory, that these people who are buying and create these patterns that we're getting into ourselves are very well informed, and that's what creates the pattern. Like I said, I can't prove it because I don't know these people individually, but it happens so many times that it's a logical conclusion. Anyway, I hope that answers your question. I hope that clears up my strategy as to why I sell sometimes before it gets to my target too. Because what I'm looking for is I'm looking for the emotional outburst, and I'm trying to judge whether that outburst has run its course or not. Sometimes it gets all the way to the target, and sometimes it doesn't. It falls short. Sometimes it goes past the target. So when I'm selling before it gets to the target, it's because I'm selling this emotional outburst that comes into the market. Now, if the stock were to go up steady, nice and easy, nice and quiet, without that emotional outburst, I would continue to hold the stock. I'm looking for that release of energy all at once, that people get emotional and just run the stock up 20, 30, 40, or 50% in 2 or 3 days. That's what I'm looking to sell. If that happens, I'm gone. And then I'm looking for my next ascending triangle or a descending triangle or reverse head and shoulders or some other, bullish looking patterns. So anyway, I hope that answers your question. Next question comes in from sorry, there's no name on this, but it's a good question. I always enjoy watching your videos. Here's my question: where do successful traders who have a couple of million trading capital park their uninvested cash balances? In MMAs, return on cash in MMA these days is 1 to 2%. Is that the best possible yield on uninvested cash these days? Well, if you're going to need the money, the next day to trade, that's the best you're going to get. That's overnight cash, because you're going to need. You don't know exactly when you're going to need the money. It could be 2 days, 1 day, 3 hours later. But if you have a couple of $1 million, let's say you start with 100,000 and you get up to, let's say, 2 million. Okay, my suggestion is to take some of that money out of that account, because the more money you get, the more over trading you're going to do, and the more times you're going to be wrong. You wind up getting into an area of the law of diminishing returns. So you should take $1 million of the 2 million or $1.5 million and put it somewhere else, treasuries where you can get more return on money. But if there's money you need to trade the next day, the best you're going to get is this overnight cash. But remember, once you build this, you should only keep enough capital around to keep yourself hungry. Once you start getting too much money in the account, you start over trading, and then things can blow up on you. So keep yourself hungry at all times. Okay, so that's my question and answer for the weekend. I hope I cleared up some questions, and I hope some people learned some things. Anyway, this is TK signing off. See you Monday.